If you're a house flipper, the price you pay to acquire a home right now depends on what you can resell it for later after fixing it up. And as of this recording, we've been in the hottest real estate market in history over the past year, but are there signs that the market may slow down? What should you do right now to prepare for a market correction? Find out on today's video coming up.
For a limited time, you can get a free copy of Jerry Norton's Virtual Flipper Kit with everything you need to flip houses without seeing them in person. Download it now at virtualflipperkit.com.
If you're new here, my name is Jerry Norton, and I've been a full-time real estate investor now for over 17 years. Amongst other things, I specialize in flipping houses all across the country, and I've helped thousands of new investors get into the game of flipping and create six-figure and even seven-figure incomes. If you want to learn how to flip houses so you can live your dream life, be sure to subscribe to my channel and click the bell icon to get notified when new videos are released. First, let's make sure you're clear on how flippers and wholesalers determine the price they can pay right now when they buy a house in order to make money later when they flip the house. When considering a deal to flip, you always start with the future value of the home based on what the market will pay for that particular property once it's fixed up. The future value is called the after repair value, or ARV. In other words, if I buy this house today, then spend the next several months making specific improvements and updates to the house, what will the market pay for that home after it's fixed up? Then from there, decide what price you should pay to buy it. Now, the process of determining the after repair value and calculating the cost of repairs and the time frame it will take to make those improvements lets you know that the price you should pay for that house right now to make it a profitable deal. So let's quickly discuss some industry jargon and associated acronyms so you can follow along. Now, I already mentioned that the future value of a home after it's fixed up is called the after repair value, or ARV. Now, I also sometimes refer to the ARV as the back end value. In the industry, we call the process of crunching the numbers to figure out the buy price, analyzing the deal, or deal analysis. The highest price you pay for a deal is called the maximum allowable offer, or MAO. And the process of determining the ARV of a property is often called comping the property, which is referencing the process of looking at comparable sales. And I usually refer to the property I'm analyzing as the subject property. Now, you want to make sure that you're proficient and competent in all areas of deal analysis. I did a video where I break down all the numbers to consider when analyzing deals. It's the most comprehensive explanation explained in the most clear and concise manner that you can find anywhere. People tell me all the time after watching that video, they finally understand deal analysis. So make sure you watch that video. I'll put the link to that video in the description box below for you to watch later. And wholesalers, listen up. You're not totally off the hook. Just because you're not the one who's going to fix up the property and resell it, your cash buyers are. And if you want to bring cash buyers good deals, you need to know how to find and source good deals that meet their criteria. That means the better you are at thinking like a flipper, the better you'll be at bringing them deals that they will want to buy. So this applies to you as well. Going back to determining ARV and how the real estate market plays a role, there are two major things to consider when determining the ARV of a property. Method one is the safest, and that's the base future value by looking at historical data of other renovated homes that recently sold in the same area that are similar in features. Now, if 5 identical fixed up homes sold on average for, let's say, $350,000 over the past 6 months, it's safe to say that the subject property will also sell for $350,000. Why? Because like all things in life, past performance is the best indicator of future performance. I like to say that the market doesn't lie. But while historical data is the safest way to determine ARV, it might not be the most accurate depiction because it doesn't take into consideration appreciation or depreciation for that matter. For example, if you're looking at a subject property that requires 6 months of renovations until it will be ready to sell, despite historical data, the home value in 6 months from now could be worth more if the market went up over those 6 months, or it could be worth less if the market went down over those 6 months. Making decisions based on appreciation or depreciation is called speculating. And speculative investing can be lucrative or devastating and involves a certain level of risk. For example, the real estate market crash of 2008 was caused in part by massive speculation from investors. People were buying in the present with the assumption or speculation that it would be worth a lot more in 6 months or a year. They were basing those speculations solely on the fact that that's what it's been doing and assumed it would just continue to go up forever, I guess. At the same time, banks were giving investors zero down loans to buy real estate at inflated values. Then when the market corrected, millions were instantly upside down in bad deals, and since they acquired those homes with little to no money down and didn't have any skin in the game, it was easy to walk away and millions of foreclosures ensued. All of those investors quickly realized that spec investing works until it doesn't work. And that's the scary part. At some point, the market has to correct. The music has to stop, and someone is always left without a chair to sit in. But is it possible to feel confident or at least comfortable with speculating on an increase in ARV? And at what point should you adjust down your ARV to anticipate a drop in value? Let's discuss appreciation first. If you're going to speculate, let's base that speculation using as much data as possible to lower the risk. There are indicators we can look at that will give us enough information to make sound speculations. Now, I personally like to follow the Shiller index, which tracks the changes in value of single-family housing in the US. Now, I'll put the link to their site in the description below. I also like to follow the AEI Housing Center, which tracks data real-time on home prices using data from Realtor.com and Zillow.com by looking at 40 of the largest US metropolitan areas, as well as the nation as a whole. Now, I'll put the link to their site as well in the description below for you. When looking at housing data, there are two primary indicators to understand and watch. First is the appreciation index. This index measures how much home prices are increasing or decreasing. This data can be looked at by major metro market, the nation as a whole, and month over month or year over year. So how can this data be used for a flipper when considering ARV? Well, let's say that you're a flipper in the Seattle market. In June of 2021, home prices rose 25% from 1 year previously. That means if I bought a house with an ARV of $500,000 in June of 2020, 1 year later in June of 2021, at 25% growth, the new ARV is $625,000. It went up $125,000 for no other reason than 1 year went by. So let's play out a scenario. Let's say that in June of 2020, you're looking at a subject property that has an ARV of $500,000, and based on historical data only, no future appreciation, and it needed, let's say, $100,000 in repairs, which means following the 70% buy formula to cover all of your costs and to make a profit, you would need to buy it for $250,000, but it's a competitive seller's market, and the seller is asking $350,000, and he rejects your offer of $250,000, and you miss out on the deal. Or let's say that you had a crystal ball and you knew that in 1 year Seattle would appreciate 25%. Now, instead of $500,000 for an ARV from historical data only, you use $625,000 as the ARV, which is the future value at a 25% increase. Now, following the same 70% formula, you can pay $337,500 for the deal, and let's say that the seller accepts your offer. And let's say that you take twice as long to get to rehab done, and a year later, you sell it for $625,000. Assuming you kept the rehab budget, in that scenario, you would have made $93,000 in profit. Now, the thing is, you don't have a crystal ball, which means you're speculating if you base your buying decision on appreciation. But looking at how homes in Seattle are appreciating month over month can help you decide if the market is continuing to go up or starting to slow down, and how quickly. So here's a safe way to handle this. Let's use Seattle again. Right now, as of June 2021, like I said, Seattle has appreciated 25% from 1 year earlier. And based on the indicators, let's say that you think it's going to continue increasing for the duration of your flip, which, let's just say for simplicity, is 12 months. Rather than using 25%, which is risky, what if you cut that in half and you used 12.5% as an increase instead? Or let's be even a little safer and give it a 10% increase. That means whatever the ARV is based on historical data, add 10% for future appreciation as your new adjusted ARV. Does that make sense? Follow the same process In a depreciating market, if the market is crashing, adjust down your ARV to anticipate a loss in value during the duration of your flip. That's what I did throughout the '08 market crash and into 2009 and even 2010. I assumed the ARV would be lower in 12 months and adjusted my formula to anticipate for it. Now, there is one other indicator worth tracking to help decide how the market is trending, and that is the supply of homes for sale, or what's often called months of inventory. Now, across the nation, 6 months supply is generally considered the transition point between a seller's market to a buyer's market. The lower the supply, the hotter the market. Now, this data does vary based on price point, so pay attention to that when looking at deals. There are 4 different price points to consider: low, low to mid, mid to high, and high. And just to give you an idea, the nation as a whole overall, combining all the price points, had 1.6 months of inventory in June of 2020, which by all means was a hot market. But in June of 2021, the same index was 1.1 months of supply. Clearly a super hot market, but what if it starts to trend the other way and months of inventory begins to increase? Well, then the market is slowing, so be less aggressive using a future appreciation value when calculating your ARV. So what can we anticipate right now as of this recording? The numbers for June 2021 just came in and they are earth-shattering again. Real estate values have experienced 13 straight months of double-digit appreciation. According to the Shiller index, prices rose 18.6% overall in June year over year, up from 16.8% just 1 month earlier in May. That represents the largest annual gain in the history of the index, which goes back to 1987. Now, prices nationally are now 41% higher than their last peak during the housing boom in 2006. The median existing home prices have risen to a staggering and record-breaking $359,900 in June. Now, some markets experienced unprecedented growth. For the month of June, prices in Phoenix increased 29.3% year over year. In San Diego, they rose 27.1%. And in Seattle, like I mentioned, they were up 25% year over year. And it's not just some markets. Across the board, almost everywhere, prices have been going up. But is the market about to slow down? Is there a correction coming? The early data is suggesting that the market may have reached the peak and may be starting to taper off, but is likely to stay in the double digits at least through the end of the year. I would not buy into the YouTube sensationalization that the market is about to crash. There is too much demand, not enough inventory, low interest rates, and a strong millennial buyer demographic entering the market. A market correction? Maybe. A market crash? Not anytime soon. Now, as an investor, there are some other indicators that are worth watching, such as the number of signed contracts, as well as new construction starts. But the idea is that you're doing the research each month, you're taking the time to learn how your market is trending, and if you're going to speculate, you're learning how to make logical decisions derived from actual data and then managing risk accordingly. That's how you succeed in this business in the long run. Right now, the market is very forgiving, unnaturally forgiving. What I mean by that is flippers are staying in business, not from sound business practices, but from sheer dumb luck, aka a crazy appreciating market. When the market corrects, not if, but when it corrects, and the music stops, those flippers will lose money hand over fist and quickly be out of business. Don't be that guy or girl. Now, I am very concerned about the negative consequences of inflation. I recently had the opportunity to sit down with world-renowned economist Peter Schiff, who discussed how inflation could have a huge impact on real estate and, of course, the economy. Watch that video now, and if you haven't yet, be sure to subscribe to my channel. With over 750 videos, this is the #1 channel on YouTube for all things flipping, and I'll see you on the next video.